Hey, this is Adam Huxma from Projection Hub, and today I have a set of projections from a client that was looking to start a restaurant and bar concept and looking to raise $450,000 in startup funding to be able to launch this concept. So, um, you know, what we ended up doing was kind of taking this file. This file is the file that the client sent to us initially. We ended up taking this file and kind of helping just get it up to snuff, as you're trying to raise that kind of money from investors, certain things that might be expected. But what I like to do here is just kind of go through the client file as an example so that you can kind of see what others are doing and then learn some best practices in terms of building out your own financial model for a restaurant or a bar concept. So the first thing I noticed when I took a look at this, I was looking straight at the bottom line, and I saw 24% profit margin is what was being projected on a monthly basis here. And that seemed pretty high to me. And so, just did a quick Google search, average restaurant profit margin, and you can see the first result here that restaurant profit margins typically span from 0 to 15% and usually fall within that 3 to 5% on average. And so right off the bat, this kind of screamed at me that this is multiple times higher than average, and so something seemed a little off there. With that in mind, then I kind of went through and tried to see if there's anything obvious that jumped out at me that looked out of place. This seemed a little bit strange. I'm not sure why. So you see you've got 48% total expense ratio, 48%, and then these 2 months jumped to 66. And I'm not exactly sure why. So yeah, it looks like there must be some sort of error here. Because you've got the same sales level. So why is that 66% and why is this 48%? I'm going to look at this equation. Yeah, so they're pulling the wrong, they have an error here. Okay, this is actually correct. This is total expenses as a percentage of revenue, and this percentage is total expenses as a percentage of gross profit. So that stuck out to me as something strange and actually was an error. So just an error in the equation there. But the numbers are still the same. So, let's jump into these other tabs and see if there's anything else that kind of sticks out that maybe is making this model extremely profitable, or are they missing some expenses here? So you can see the different positions: a general manager, chef, 2 cooks. So this is the number of positions, and then the salaries for those positions, the number of hours worked, and it gives you a total payroll expense. Jumping over to the daily sales, we can see no breakfast or lunch, so this is really just a restaurant and bar concept. Just for dinners. The way they're coming up with their sales projections, if I click into this, it's taking this $40 average check or bill times 75 here. So they're assuming 75 tickets, customers that night on Mondays, and then it really just 100 for Wednesday and Thursday, going up to 150 here for Friday and Saturday, and then back down to 75 for Sunday. So, that makes some sense. Probably, it makes sense that you're going to be busier on Friday and Saturday, right? The question here is, a couple things. How do they know? What's driving them getting 150 paying customers in the door? that's a question. It doesn't look like there's some sort of marketing budget or advertising budget that's kind of driving customers. It just looks like they picked a number. We also don't have any concept of what their capacity is, so we don't actually know. I don't think there's anything in this model that shows us how many customers could they have on a night. Is 150 at max capacity? Could they do 200? And really, you know, there's nothing kind of keeping them honest to make sure that they don't project over what their actual capacity is. So that's one concern I would have. Jumping into the startup costs, I think this actually they did a good job going through the different startup costs, construction costs, equipment, bar equipment. I mean, this all looked pretty detailed and seemed reasonable and straightforward. Seemed to add up. To me, there was a contingency, which is always good to see when they add in a contingency. They had pre-opening costs, which is important. So that opening payroll, you know, you need to build in some payroll expense to train your employees before you're open. You don't just bring employees in day one and open up to the world, right? So having that built in was good. I like to see that. So startup costs made a lot of sense. On the investment side, you can kind of see here, so the founder is Class A shares and is putting in 0 in initial investment, which always, you know, makes you scratch your head a little bit or just makes you a little nervous as investors. You want to see the founder put something in, have some skin in the game. And then you've got these Class B shareholders with $450,000 investment, and you can kind of see payback by year is what this is trying to show. And they're also building in a working capital reserve. So up here, this row is the EBITDA, the earnings that is available for distribution to the investors. And then that is, okay, so 15% of that is going to the founder, and 85% of that is going to these limited shareholders. So that, you know, I think I understand how the math is working out. Again, as a potential investor or lender, you know, I'm going to be thinking, one, why do you get 15% as a founder if you're not putting in any cash yourself? So that's a question. And then I think more importantly than any of that is, boy, this EBITDA, these EBITDA numbers look pretty good for a restaurant. And is that realistic? You know, is this 24% income realistic? And I'm not seeing anything in here that makes me think, oh yeah, this is a really unique concept that's just going to be way, way more profitable than average. So there's nothing in here that shouts out like you're really missing something, but my guess is that just all of these categories are probably just undercounted a little bit. You know, really maybe general and admin shouldn't be 1.35%, maybe it should be 4%. And when you kind of do that across all these different categories, what you're going to end up seeing is that this is just going to be much lower. And when that gets down to a reasonable, even let's say it's a top performing restaurant and it hits that 15% level, when you do that and you drop this EBITDA available for distribution, it is going to take those investors much, much longer to earn their $450,000 back. So that's what I would be looking at if I were an investor looking at this set of projections. Would just be a little bit concerned about those things. So what you could do and what I would recommend that you do is really research what are industry standard ratios. It's nice that they have these percentages here. On the one hand, it's nice. On the other hand, it actually makes it really obvious for me to see, and an investor, savvy investor too, that this is just way too high and something seems off. So if you're going to put those ratios in there, make sure that you're industry standard. So that being said, we do have a handful of different templates for different restaurant, fast casual, more of a fine dining restaurant concept, a restaurant and bar concept like this. Various templates that we've built out that are really 5-year models with an integrated income statement, cash flow statement, balance sheet with some nice investor dashboards as well. And so I'll make a note of those in the description of the video. So if you want to check those out, feel free. And then also, if you have a set of projections that you're getting ready to send to investors or lenders and would like someone just to kind of do this, look through, say, hey, this kind of doesn't look right. Happy to do that. Takes only a few minutes for us to do that, and we could hopefully save some embarrassing conversations with those investors or lenders. So you can reach out at support@projectionhub.com. Just email support@projectionhub.com, and I'd be happy to take a look. All right, thanks.